Welcome to Remarkable Retail Podcast, Season 6, Episode 22, presented by Marketile. I'm Michael LeBlanc.
And I'm Steve Dennis.
For our very special guest interview on this episode, we are off to one of my favorite cities, been there about half dozen times, Amsterdam, to chat with Wim Blaauw, Chief Digital Officer, IKEA Retail, the Ingka Group.
I feel like we've got back-to-back episodes of these iconic brands that everybody's known for decades at this point. And it's just a fun company to learn about. And they're doing a lot of interesting things I wasn't so aware of.
Yeah,
all that they had up to. So it was fun to hear about that at the World Retail Congress, and then to get Wim on the mic to unpack it, as the kids say.
Yeah, and special thanks to the folks at the Ingka Group and IKEA, because they introduced themselves, and we didn't have the time. Neither of us had the time to fit it in person in Barcelona, but we did the great follow up, and it's a fantastic interview. And as you say, it's funny. I don't think maybe we should tell people we intended this to happen, but
we've been planning this for years. This is the whole arc. It's kind of like the Succession plan. We just knew how we were going to land this.
All right. Well, let's get right into the news, or should I say, let's get the Allen keys out and assemble the retail news of the week for the people. Come on, these.
How much time do you spend thinking about these intros? Trying to catch me off guard. Yeah.
These scripts write themselves. Come on. Now, we were talking off mic, and our typical review of the news. We thought we'd start weaving in, though we kind of have for many of the episodes, a bit of your predictions from the beginning of the year. And then there's a lot of predictions. We're probably not going to do a full predictions mid-year check, so to speak, but we thought it'd make a nice idea to, in the world of these things sometimes write themselves, to kind of integrate it in what we're talking about. So there's a bunch of results out and news, and it all fits kind of in your prediction of the disruptor reset. And 22, as you said, was a pretty rough year. And remind the folks what you said about 2023 for the so-called disruptors.
Well, essentially, it's that the toughness, I guess, or rough road was going to continue, at least for those that are not able to kind of right the ship. Which so far we're not seeing much of that. But but in particular, as we get into really multiple years of this kind of era of profitless prosperity, in other words, growing but not able to get on a path to profitability, that we'd start to see some big changes. So changes could include some of the founding executives getting leaving or getting kicked upstairs, lots of expense reduction to try to see if they can move towards profitability, a continuing shift, I should say, really, for most of these brands from the strategy being kind of pure DTC to doing things like more wholesale distribution. Yep. But also, which sort of plays against the wholesale thing or in concert with the wholesale thing, is maybe pulling back on their store expansion strategies, or maybe even getting acquired, or maybe even going out of business if they can't figure things out. So a lot of possibilities, and it's a big playing field to sort out. So it's not going to be one thing in particular.
Well, let's use that as a segue then. Let's go to the wobbly unicorn section of the podcast, because we've got a few examples of what you've just been saying, and the examples. We've been talking about them for many, many episodes, but highlight a few of the examples that would kind of put an exclamation point on your thinking around this.
Yeah, there are a lot of them. And as you said, we've mentioned a bunch of these along the way, so I'll be really quick about it. But I think Allbirds is a great example of a company that has really struggled to get to profitability. And if anything, things have been getting worse. So they have slowed down their store opening pace. They've been starting to emphasize wholesale more. One of their founders, he's still at the company, but he's taken a more subordinate role. We've got companies that have been acquired or maybe about to acquire. So ASOS, the online retailer, rumors that they're about to be acquired because they've really been struggling of late. And then a company, I don't know how many people would know about Boxed. Their CEO was speaking at a lot of conferences over the last few years, basically kind of essentials in a box sent to you. You kind of
literally named anyway.
Yes, very, very on the nose kind of name. They've been struggling, and they actually just announced that they're being liquidated. So there's an example of I guess a wobbly unicorn that fell over or has expired. I don't know. This is very negative. We got to try to make this a little bit more uplifting.
Now let's transition from there into some earnings. Let's start with Rent the Runway.
Yeah, just part of the reason to connect this to the prediction is we did have two of the more prominent disruptor brands report their earnings this past week. Rent the Runway, I guess, on the positive news, they were struggling for a while getting the top line going, and they were losing subscribers. They've started to turn that around. So they had about an 11% sales increase. They had growth in active subscribers.
We don't hear that often, right?
No.
We don't hear that often in this group.
Greatly improved their gross margin. Now, some of that was clearing out some inventory, I think. And they did cut their net loss by about $10 million. So that's positive. However,
that's what positive looks, by the way, for many of these is they lose less, basically. Is
correct. Yes, which we'll get to in a second. Another one. Yeah. But their net loss is still 40% of sales. Now, one thing I should point out, which is makes it difficult to compare to brands, sort of big established brands, as many people might know, most of these disruptor brands, there's a lot of money that goes into stock compensation. So that's a big expense line on a GAAP recording basis. So we have to look at the loss a little bit with a grain of salt. It's probably better to look at an adjusted EBITDA margin or their cash flow. Now, on that basis, they have reduced their negative cash flow. So also going in the right direction, but still there's a lot of cash going out the door. The company's stocks recovered a little bit, been less bumpy, but it's down like 80% since they went public about 5 years ago. So they got a lot of work to do there. Then the related one, just real quickly, kind of a similar story, big picture, Stitch Fix, except that they are having a hard time getting the top line moving. They had a 20% decrease year over year. Their active clients down, revenue per client down. But they have started to make some progress on cutting their losses. They did have positive cash flow. Some of that's some inventory adjustments. So that's maybe kind of a short-term thing. But again, another one of these disruptor brands that has seen their stock absolutely collapse. They're actually down over 90% in just the last 2 years. But because they cut their losses, the stock bounced back a little bit. But anyway, I guess, it's still a picture of some progress. Yeah, but both of these companies have a long way to go to get to profitability. And the economy is probably not going to help them too much over the next 6 to 12 months.
Well, in the case of Stitch Fix, what also probably, and we've talked about this in the pod, so I won't dwell on it too much, the double tap on them, so to speak, is with less people going into the office, they don't need 5 day a week of apparel, right? So that's got to be kind of a drag. And then, just secondly, you made the point that, they probably tapped out on their addressable market. Like the addressable market just doesn't keep going up and up and up. There are only a certain number of people who want to, consume or get product in their subscription service. But anyway, we wish them, as always, we wish everyone the best of luck. Now, let's talk about the collapse of the unremarkable middle picking up steam. And that was a kind of a foundational element, really building on a lot of your work. And it was one of the predictions. Now, we don't have to go too far to think about this. There is some brighter points, but, when you think of what we've been talking about, I don't know, JCPenney, we haven't talked about JCPenney actually in a little while, Macy's, where do we think after a bit of a hiatus, can we say, for trouble during COVID, they actually probably benefited from COVID in a weird way? Where do you, that's gone. Where do you think they are now?
Yeah, I think that we touched on this a little bit. I mean, a lot of this I cover, for people who've read my book. I mean, I cover the collapse of the unremarkable middle is kind of a key theme, this idea of the bifurcation, et cetera. We've talked about a bunch of times, so I won't go into that. The point here was what you're saying, which there was a little bit of a pause due to some, due to COVID, due to some other
shopping dynamic changes.
Right. And then kind of this bounce back that maybe masked really the underlying trends. But the underlying trends continue to be quite poor. And what we're starting to see, and I've talked enough about the department stores, so I think I'll skip that for now. But we're also continuing to see this more broadly. We're seeing store closings picking up pace. According to CoreSite, they're up 61% year over year. Now, Bed Bath & Beyond accounts for a lot of those
big chunk
stores.
Of those,
so it's a big chunk. So I think we want to get a little bit broader sample before we draw too much from that. But everything from Joanna's stores, a craft store, to DSW. I mean, a lot of these brands that were kind of, had an interesting niche maybe 20 years ago, but have really gotten more competition, not only from the internet, but from some more specialty stores. They're really struggling. A number of them are on, bankruptcy risk alerts and those kinds of things. So we're not seeing much evidence of any kind of turnaround or any kind of sustained growth. So I think this continues to be a place to watch. I think we will see some more bankruptcy filings in the back half of the year, and I do think we will see some pretty large-scale store closings on the part of these retailers the balance of the year, and frankly, probably a lot of it will occur after the Christmas holidays. So it doesn't quite make it into my prediction year, but that's sort of a timing issue, I guess.
Let's talk about Nike and Macy's and what's happening in luxury that you're picking up on this week.
Well, there's been some interesting stories about Nike deciding to go back to Macy's. And I've seen some stories talk about, Nike's direct-to-consumer strategy is not working. And many of those stories state that Nike intended to completely get out of wholesale, which is 100% not the case. So one is just those stories where they, like Modern Retail had a story on that they're going back on their plans to go totally direct. Nike has never, at least publicly stated, they've never publicly stated that. I can't, Nike's a former client of mine, so I can't speak too much specifically, but based upon, and I haven't worked for them for a while, but I would be shocked if they ever intended to go fully direct. Let's just say that.
It'd be very uncharacteristic of them to do such a...
Yes. And in fact, they've said many things that make it clear that they understand a balance between wholesale and direct-to-consumer. Having said that, I think it is interesting that they are backtracking a little bit because they did exit Macy's, and now they're going back in. And I do think that suggests, number one, that they need... maybe there's some opportunity because they're over inventoried. I think this is a little bit of kind of getting their nearer term performance back on track. I also think it suggests that, yes, maybe they have concluded they went a little bit too far. In the scheme of things, Nike at Macy's, because they're not, I think, only going into not a handful, but a limited percentage of stores, not big in the scheme of Nike's overall strategy, nor is it going to be a game changer for Macy's. So there's kind of much ado about nothing, I think, to a certain degree, but mainly I just wanted to kind of correct the record that Nike has never said they wanted to completely get out of wholesale. And then just really quickly on luxury, there's kind of this narrative, and we touched on this a little bit an episode or two ago, that luxury is immune to economic down cycles. And my experience at Neiman Marcus is that the very, very high end of luxury is pretty much immune. But the more accessible luxury segments, which, probably accounts for 60 or 70% of the sales at retailers like Saks or Neiman Marcus, that can be very much affected by economic down cycles. And the reason we have this story this week is that both Saks and Neiman's commented on their financial performance. Neither one of them are public companies, so we don't get quite the level of detail, but they do share information with the markets. And Saks is complicated now because they got Saks Fifth Avenue and Off Fifth and .com and stores. And so, but the net picture from Saks was that their business is pretty much down across the board in all four parts of that business. And then Neiman Marcus Group also reported that their sales were down in the most recent quarter by 9%. So that's a pretty significant decrease. My expectation is that the top part of that business is flat to up. But the rest of the business is down more than double digits. So, and, similarly, their profits aren't great. One of the comments that the Neiman CEO made was that in addition to just people pulling back on more discretionary spending, they're also very clearly seeing that the high-end customer is shifting their spending towards travel in particular and more experiences, which, we've touched on that as a broad trend for the industry. But he said they're particularly seeing that with their customers. So I think that's something to watch going forward.
Let's end on the value end of the equation. Let's talk about Walmart. And I think sometimes we lose track of how big they are and what a percentage or two means to Walmart. So comment on that compared to, you just put it in some kind of comparison to folks, just so we continue to benchmark what big looks like.
Yeah, well, I was reminded, this is probably going back 20 years ago. I was at a Harvard Business School conference event where one of the professors talked about how big Walmart was and how at the time Walmart was growing, 5 or 6% a year. And he made the comment that if you think about 5 or 6% growth on top of how big Walmart already is, again, 20 years ago, he said, they're growing a JCPenney, I don't know, he listed a bunch of, big brands every year. And I was like, wow, yeah, I guess, if you stop to think about it, that must be true. Well, sort of a similar thing came out this week because Walmart, in addition to reporting the growth that they've been experiencing, but also because of some of their plans, as we talked about with Judith McKenna, the president of Walmart International, to add $100 billion in incremental sales. Yeah, last year, Walmart grew by the equivalent of Dollar General's entire sales.
Right.
And I know we have some people from outside the U.S. maybe not know Dollar General listening, but Dollar General is a huge dollar store.
Thousands of stores.
By the name. Thousands and thousands. I don't know. I don't even know how many. Yes, many thousands. Many stores. Of stores. And yeah, it just, when you get to that scale, it's pretty incredible. But to think about how much market share, some of this is inflation, of course, but to the extent that they are picking up real growth, that is just a lot of customers, a lot of transactions. The scale of it is for companies like Walmart, like Amazon, like Costco, like Target. It's really quite extraordinary.
Well, that's a wonderful segue you just created for us there to a little bit of a promo for our next upcoming episode, which is an exclusive interview with Jason Del Rey and his new book coming out, Winner Sells All, Amazon, Walmart, and the Battle for Our Wallets. So I'm just halfway through the book. It's a really interesting book, and we got Jason on mic. So lots of great insights and discussions to follow. Now, just before we get to our excellent interview with Wim from IKEA, let's hear from our presenting sponsor. If you're a retailer hungry for a better way to gain useful insight on the impacts of your store layout, design, and strategic initiatives, you need to know Marketile. Marketile is an easy-to-use testing platform that emboldens great decisions, leading to reliable, scalable results. With Marketile, you can be confident in the outcome of your in-store pilot initiatives before rolling them out across your fleet. Validate your remarkable ideas with Marketile's in-store testing solution. The proof is in the testing. Learn more at marketile.com. That's marketile.com. Wim, welcome to the Remarkable Retail Podcast. How are you doing this afternoon?
Yes, thank you. Great to be here. Doing really well. Sitting here in an office with a lot of people. We're celebrating Midsummer today, so that is pretty exciting.
Well, fantastic. Now, Steve and I had the opportunity to meet you in person. You stopped by. You were kind enough to stop by and say hi before we jumped on the mic today, back in Barcelona at the World Retail Congress. Where are we finding you today? Where are you sitting today?
Yeah, so today I'm in Amsterdam. We have a hub here in Amsterdam where we actually have quite some digital folks, over 500. We established this hub it's 2 years ago actually. So this is now one of the digital hubs that we have around the globe.
Fantastic. I love the city. I was there this time last year, actually. What a wonderful city and a real hub for digital, right? It's a very advanced city in terms of attracting a lot of talent. I guess that's what attracted you to set up your hub as well.
Yeah, 100%. Of course, the main reason to also establish one in Amsterdam was the availability of fantastic digital talent here.
Yeah. Not to mention, it's such a wonderful city. So it's nice when the two come together, right? Well, listen, tell us a little bit about yourself, your background, and the work you do at Ingka.
Yeah, so maybe a little bit of background. As said, my name is Wim. I work as the Chief Digital Officer for Ingka Group. What we do is we run IKEA Retail, amongst a few other things, but maybe we can come back to that. Mm-hmm. I've been with IKEA for it's actually quite remarkable, almost 21 years.
Wow!
I did not imagine that when I joined back in 2002.
Yeah.
I'm Dutch. I grew up in the Netherlands. I studied logistics and economics. And, after a few years of work experience, I decided to apply at IKEA. First of all, it was a real fun place to shop. But I also heard very good things about, leadership, the culture and the values. So I applied. I wanted to work on logistics because I have a logistics background. There was not a logistics position available back then, but there was a really good click and fit between us. So I decided to jump when they offered me another position that had nothing to do with logistics. It was a role in store operations. And I joined. I joined 6 weeks before we opened a store in the Netherlands. And it's been amazing ever since, I would say. Right? I've worked in different stores. I've worked in country organizations in the Netherlands and in the UK. I've worked in different group functions, and now I have this fantastic opportunity to lead the digital developments for Ingka. So it's been really great.
Fantastic. Well, a click and fit, I might say, just like the wonderful way your products go together. So I love the way you described it. Now, I wanted to touch on one thing, and I've described you as with Ingka, and you joined IKEA. So how the listeners understand the difference between those two things? Because I don't think that's commonly known.
No, I think that's a fair question. We have quite some companies in the total IKEA ecosystem, but obviously there is only one brand, right? And I think that is probably the most important thing to remember. For our customers, there is only one brand, and that is IKEA. But what the company that I work for is called Ingka Group. What we do, we have three core businesses, right? One of the core businesses is Ingka Investments. The other one is Ingka Centers, and by far the largest one is Ingka Retail, IKEA Retail. So what we do, we operate the retail business, the stores, the online business. There are more companies like Ingka, so we are a franchisee. But we are the largest one, right? So we have more than 90% of the total retail business globally. Right. We run almost 500 stores in 31 countries. And then, of course, we have online, the app, and so on. That means that we are part of a franchise system, right? So there are the franchisees, and then there is also the franchisor, which is called Inter-IKEA Systems. And that is where we have, to simplify, production, product development, and distribution. And that is also the company that is responsible for the concept and concept development. And we work very closely together.
Well, I would say it's wonderfully opaque, I guess you could say, to consumers, even folks in the trade, right, Steve? I mean, Steve, you and I had this idea when we were sitting in Barcelona. We were like, what is this Ingka Group? And you know, we've been kicking around in retail a long time, so it's wonderfully just brand forward, blue box forward. Question for you around, and this kind of came up as a general overall theme, both when we talked to you in person and just hearing you on the stage. Just the evolution of digital transformation that you described to us was in a human-centric way, and of course that got our attention. Talk about that a little bit.
We are now on the second version of our digital strategy in Ingka. We have 4 pillars in that strategy, which is around customer experience, coworker experience, digital DNA in the company, but also making sure that we have a modern foundation. But in the core of the strategy, we have said, human-centric technology. And that means that we want it to be intuitive. We want it to be, when we think about data, we want to do that in a responsible way. Also thinking about, and I also spoke about that at World Retail Congress in Barcelona, when we think about AI and all the fantastic opportunities and possibilities that it gives, it also comes, in our opinion, with a responsibility to do that human-centric and to do it in a responsible and in a good way. So that is really how we want to work with the digital transformation and with our digital strategy, and that very closely links as well to the vision of IKEA, because the vision of IKEA is to create a better everyday life for the many people, and of course we do that by offering fantastic home furnishing products at low prices. But there is so much more to it, right? So how we do our business, how we work with data, how we work to sustainability, how we want to do things in a responsible way is very much linked to that vision. And that's also what we wanted to incorporate in the digital strategy with the human-centric technology.
So could we talk about that a little bit deeply? I really enjoyed hearing your presentation at the World Retail Congress. And it's not necessarily to just try to give our listeners a sense of specifically what you talked about at the event, but so many of the themes you got into, responsible automation, sustainability, building agility into your operating model, I thought were really fantastic. Could you maybe take those and give us a bit more of a sense of how you got there, what's going on right now, and really what you're aiming to achieve?
Yeah, well, the main theme of the speech in Barcelona was about responsible automation, which is, of course, one, but an important angle to it, right? Because in what we're doing right now in the whole retail and digital transformation is a lot around, I shared examples such as drones that do inventory checking. I shared some examples around things that you can do in the app, but also automation in our stores, because our stores more and more, apart from stores, experience centers, they also more and more serve as fulfillment units. And that's all great and important, and of course it helps us to be more efficient. But at the same time, we also want to do that in a way where there is a win-win also for our coworkers, right? So the automation obviously comes into play in order to make life easier for our customers, better for our customers, easier for our coworkers. But at the same time, it is also a fantastic opportunity to create more value for the work of our coworkers. So if it is an opportunity for us to upskill and reskill our coworkers, and by doing so, it really becomes a win-win, right? So because we have the automation, which of course helps us in the end with better customer service and with our profitability, but at the same time, we also have an opportunity to make life just easier and better for our coworkers. So that's one example around responsible automation that I shared. Your question, I think, was a bit broader, right? And then when we look at the strategy for the totality of the IKEA companies, what we want to achieve, we want to be more affordable, we want to be more accessible, but we also want to be more sustainable. So better for the planet and for the people, and that is super high on the agenda. We have really strong commitments around becoming climate positive by 2030. All right, which basically means that we want to reduce more greenhouse gas emissions than we create, even taking our growth into consideration. And we do that in many different ways, right? We focus on renewable energy. We have very strong commitments to do last mile deliveries with EV vehicles. Obviously, we help our customers with sustainable products that help them to reduce energy consumption and water consumption. Yeah, and there's actually a lot more ongoing.
Yeah, I think it's as I said, I found your discussion really, really interesting. I'm wondering, I guess, both with respect to implementing automation, but also with some of the sustainability initiatives. One of the things that we hear a lot is this concern that more automation, whether we're talking about robotics or generative AI or what have you, is going to eliminate a lot of jobs, or that sustainability is really expensive to implement, and therefore it's really a trade-off between kind of doing what's right for the world and doing what's right for shareholders and those sort of things. Do you feel like those are false choices, or how do you navigate that kind of thought process when you move forward on these initiatives? Because obviously you're doing quite a lot in both regards.
So we did a leadership program not so long ago with many leaders in the Ingka system. Leadership in a New Era was the name of the program. Not the first version, by the way. We started with that pre-pandemic, and I think it helped us a lot. mainly in the context of, I think, resilient, and how you lead through those difficult times. Leadership in a New Era 3.0 that we just did was very much about adaptive leadership. And one of the topics that we discussed was how you deal with polarities. And I think these are typical examples of polarities, right? So on one hand, yes, you put in automation, but you want to do that at least we want to do that in a responsible way. So it is true, certain jobs will disappear. But we are really convinced that many other jobs, right, now and in the future, are going to be created. And then we should also not forget that we are still growing. That is one. We are developing our business, so that also comes with new opportunities. And it is also, we think, an opportunity to have more co-workers with full-time contracts, right? Obviously, in the retail business, there are a lot of part-time contracts.
Right.
And that comes with issues, right? Because people often need a second or even a third job, right? When you look at the retail business in its totality. By doing this in a good way, with the creation of new jobs that will be there and is super high on our agenda, we believe we will have the opportunity to provide more full-time jobs to people. So that is, I think, one example that you were after. We strongly believe that it should not be the case that when you buy a sustainable product, that it's more expensive, right? We strongly believe in the combination of affordability and sustainability, and we have actually many good examples in the business with fantastic sustainable products that also have a low price. So it is possible, we believe, and it is really high on the agenda to have more and more of those examples for both our customers and for our co-workers, because I think it's, first of all, the right thing to do. And it is also very clearly linked to our vision in order to create a better everyday life for the many people.
It's a fantastic discussion around refusing to make the traditional trade-offs, right, that you've just described. So it's really quite encouraging. Now, if we could step a little bit into the business side, many things attract our attention about the brand, but there was some recent news about some very significant expansion plans, particularly here in the U.S. for we call them the big blue boxes, but also very interesting and a variety of small store formats, some of which we've seen are in the country. Can you step out and give us a sense of where the expansion and the growth of the retail business is headed? And is it a global strategy or is it a kind of market by market strategy?
Yeah. So the US investment as such, right, that we announced not so long ago, is a US 2.2 billion investment. And this is really about, let's call it key strategic retail and digital investments. So it is about investing in the existing stores. It is about opening new store formats, let's say the traditional blue boxes, but also smaller formats. But we also want to invest in fulfillment and services, because this needs to be a perfect combination of how we can enable omnichannel retailing in a good way. So all those different elements of omnichannel retailing, including new digital capabilities to do orchestration for orders, for example, is all included in that investment in the US. But it's not the only thing we do. There is a very strong plan to expand in India. We also recently announced that we are doing a 1.2 billion euro investment in France. Wow. So our expansion agenda is quite big and aggressive, I would say. And then I don't know if you picked that up, but yesterday we also announced that we did another acquisition in the USA. Around a company made for net. which is a warehouse, a software provider, warehouse management and fulfillment management system, and that is of course going to serve. It's going to help us in all countries, but definitely also in the USA. We are continuously investing in the expansion of the brand.
That's super exciting. I'm curious if you could, and this is a little bit of a self-serving question in a way, because I was excited when I heard about some of your plans, because I think it very much fits with what I've been writing about and speaking about in terms of how retail strategy needs to evolve and being more hybrid, both between physical and digital, but also thinking about a portfolio of different formats. My belief has been that there was this era, I think, throughout most of retail in different countries, that most retailers had kind of a one-size-fits-all strategy. They had whatever their particular box was. Obviously, people are quite familiar with the big IKEA box. And that was the thing you kind of kept stamping out. And I think it's become harder and harder, somewhat by virtue of the way competitive strategies evolve, somewhat certainly because of e-commerce and just general trends. It's become harder and harder to kind of be a little bit of everything for everybody anymore. So one, I guess, that seems to be part of what you're doing, but more, I'm curious, how did you get the team to shift away from that kind of one size fits all strategy that was been so successful for so long, to embrace this more hybrid, diverse, integrated, whatever you want to describe it, approach? Can you give us some insight into the process and just culturally how you got there?
Well, first of all, this is of course very much customer led, right? Let's not ignore that, right? This is the whole retail disruption that has been going on for quite a while now is a combination of customer expectations and retail innovations, right? Because they go hand in hand. Because of retail innovations, customers expect more, and so on and so on. So then we have had a traditional single channel cash and carry model for a very long time, right? And it has served us extremely well. It's been a true win-win, I think, for our customers and for the company. Right, with the perspective that we had the furniture in our big blue boxes, the customer would pick it themselves from the shelves or from the sales spaces in our market hall. They would bring it home themselves. They would assemble it themselves, and because of that, together we were saving money. Right? It's actually our founder did an amazing job. I think a fantastic formula that worked really well for a long time. Then, of course, the online players arrived, and we were a bit late to that party. There was definitely some kind of disruption ongoing. Our CEO, Jesper, arrived now soon 6 years ago. After doing a tour around the globe, where he visited many stores, many countries, had lots of conversations, we together in the company wrote a new retail strategy. And in that retail strategy, one of the first slides was, we are going to change everything. And then it said, between brackets, almost. And we said, and the almost was really the reference to our fantastic range, our culture, and our values, because we strongly felt that we should not change. But apart from that, the whole business model, how we would do retailing, how we would work with digital, and many other topics, were all open to change. And that's basically what we have been doing in the last 5.5 years. So from only the big blue boxes, we established a digital organization where we brought in a lot of new talent. Online sales grew slowly until the pandemic, but we were already preparing our systems for more significant growth, which was a good shout. Then we were also saying, okay, we have the traditional blue boxes, which sit a bit on the outskirts of the cities. why don't we also open store formats closer to where the people live? And then we have an opportunity to repurpose those stores, which are still fantastic and big, and you can shop and you can have the experience. At the same time, we're also using them for fulfillment. So that was the whole, and much more. So I think the biggest cultural shift here and the change, I would say, was taking in all those new competences, mainly reflecting here on the people that started in the digital organization. Because we had a history of many retailers that have been around for a long time. And in that cash and carry model, they have been fantastic and still are. But all of a sudden, we were creating that blend between new competence, new experiences, digital competence, and bringing the old and the new together. And I must say, of course, that always comes with a bit of pain and some hiccups. But I would say where we are right now, I'm really proud how we have done that. And I think we see the end result in the retail, in the IKEA retail landscape. All the things that we have done, the expansion plans that we have, but also in the results, because the results are quite good.
Well, it's super exciting, and I'm really looking forward to seeing what else you do. When you were speaking, I was reminded of a quotation I included in my book from this U.S. general that says, "If you don't like change, you're going to like irrelevance even less." So yes, a lot of times transformations can be quite painful, but I think the not changing part could be quite painful as well.
So, yes, it's there. Of course, there is some pain involved in that, right? And it should be like that, because otherwise you don't grow. But it is also really fun, right? Because it's also one of the core values that our founder had was renew and improve. Right, and this is so much connected to one of those core values that have been around for a long, long time in the IKEA business. So it also works really well, and it fits really well.
I'd just add, and then Steve, I'll throw the mic back to you to bring us home, is that there's another example of a refusing to make the trade-off between hard work and fun, right? That it can be both, and then organizations can move forward with a very, very positive culture and not make whether they're false trade-offs or just not accept that there's a trade-off to be made. So with that, Steve, back to you to bring us home.
Well, I love the conversation. Thanks so much for joining us, Wim. I'm wondering if there's anything else just before we wrap up that we didn't get to that you wanted to mention, or anything that we should be looking forward to on the horizon.
Well, maybe just one. We are turning 80 this year as IKEA, and I think we are still very young. And I think it is so. This celebration we call assembling a better future together. And I just wanted to mention that because I think it is a quite iconic moment for us. We, of course, are going to do some great things for our customers and for our co-workers. There is going to be a special collection where we bring back some icon products in new colors and new materials. And there will be more. But I think it is just important, this assembling a better future together, I think really represents what we stand for. Because we have not done this alone, right? We have always done this in very close collaboration with customers, suppliers, and many others. And I probably stop there.
Okay, well, that's great. I love it. We look forward to everything else you're going to be doing, and congratulations on that milestone. That's very exciting. And we hope to catch you again somewhere out in the world. But thanks for joining Michael and myself on the Remarkable Retail Podcast.
Thank you.
If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platform, so you can catch up with all our great interviews, including Judith McKenna, President, International, Walmart. New episodes of Season 6, presented by our friends at Market Dial, will show up each and every Tuesday. And be sure and tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, and producer, and host of a series of retail trade podcasts, including this one. You can learn even more about me on LinkedIn, and you can see both of us at the Lead Innovation Summit in July, live on stage in New York with our friend of the pod, Simeon Siegel from BMO. Until then, safe travels, everyone.